How can you afford a house in Canada today, especially when you have a little bit saved up? I'm going to share this strategy with you right now. This is similar to what Michael and Heather had done when they were interviewed by the Global News about the same topic. I've been in the housing industry for nearly 20 years, and I believe that anyone, no matter where you come from, can copy the same model. I'd like to break this all down for you so you can finally reach your dream of home ownership.
If you want to skip to the end to see Jack's success story, skip to the 10-minute mark.
But first and foremost, without understanding this important structure, no one will be able to purchase a property. Understanding the down payment structures are extremely fundamental because you need to know where to start. A down payment is simply a deposit that you put into the deal when you buy a house. The other part comes normally from the bank. Together, your portion and their portion, the bank's portion, will add up to 100% of the purchase price. Since the mortgage rules changed in December 2024, there are new rules to keep in mind. For home buyers, insured mortgages are now available for homes valued up to $1.5 million, a massive jump from the previous $1 million cap. This game-changing shift transforms how much you need up front. Instead of needing 20% down or $200,000, you'll need only $75,000 with an insured mortgage. For example, if you want to buy a home that's worth $1.3 million, you'll need $25,000 for the first $500,000 portion, which is simply $500K multiplied by 5%. Then $80,000 for the remaining $800K, which is $800,000 multiplied by 10%. So in total, you need $105,000 to buy a $1.3 million home, which is $25,000 plus $80,000. Versus before it was $260,000. One can now access the home market with less down payment. This equates to $155,000 less compared to a few months ago. Essentially, your money can go further with today's mortgage structure. Also, in order to qualify for a loan, the bank normally can lend you 5 to 7 times your combined gross salary. But if you think the monthly payments are unrealistic, there's this thing that can assist in reducing that monthly payment. Since December 2024, first-time home buyers can now qualify for a 30-year amortization schedule, unlike the previous 25-year one. Amortization is essentially a big loan, like a mortgage, broken into smaller regular payments over time. Each payment pays off part of the loan, called the principal, and part of the cost to borrow, called the interest. At first, more of your payment goes to the interest, but over time, more goes towards paying off the loan. Eventually, with enough payments, the loan is fully paid off. The longer the loan period, the lower the monthly payments will be, and vice versa. For example, on a $1 million mortgage at 6.5 interest along with a 30-year amortization schedule, you'll be paying around $6,300 a month. But with a 25-year amortization schedule, you'll need to pay even more, around $6,700 a month. This translates to around $400 per month in savings. It is also important to note that for the minimum down payment structure, you may need to consider incorporating the mortgage insurance into your monthly payments. It is true that the cost of borrowing is more if you put less down and increase the amortization, and you will be paying the mortgage for a longer period of time. However, you will be paying less per month, which frees up your cash for other things. Or if you don't have anything else to spend on, you can prepay your mortgage at the end of each year without penalties up to a certain amount, normally 20% of the outstanding balance. There's also this one thing that can reduce your monthly payments even more that we should also discuss. It will shave off probably more than a few $100 a month, but will require a greater sacrifice if you're up for it. Beyond mortgage structures and amortization schedules lies a strategy that could increase your purchasing power without increasing your budget. Let's take Toronto as an example. The city's average home price sits at a staggering $1.1 million in March 2025. Expanding your search radius by just 60 minutes drive can slash that price downward. This geographical approach can save you money. Take a look at this $1 million home in Toronto over in the west end of the city. At this price, it will get you 3 beds, 2 baths, a garage, and a lot size of 18 by 126 feet. It also looks dated. Compared to this property, which is 70 kilometers away from Toronto, and you get this, 4 bedrooms, 2 baths, garage, where the lot size is 95 feet by 170 feet, and it's renovated in a good area. You can see that a house away from Toronto has a lot size of 7 times more, but it is also away from the city if you work there, so commuting may be an issue. However, if your sole purpose is to purchase a property, tapping into a secondary market can get you into the game quicker, because for a similar sized property in the next town, your purchase price per square feet will be lower. Essentially, you are getting more bang for your buck. I'll show you in the case study later as to why you may want to consider buying in secondary markets. But first, there are some key factors many first-time home buyers never realize that they need to spend on top of the purchase price. Let's discuss this next. Land transfer tax represents one of the largest closing costs, varying significantly across provinces. In Ontario, rates progress from 1.5% to 4% of your property's value, while British Columbia uses a similar progressive scale. It is good to mention that first-time homebuyers can access rebates in several provinces, but you need to specifically request these savings. Think of closing costs as hidden traps beneath the surface of your mortgage agreement, unseen until you're about to sign. Navigating these expenses requires preparation. Legal fees typically range from $1,500 to $2,500 plus taxes, covering essential services like contract reviews and title searches. This usually includes disbursements, expense your lawyer handles on your behalf. Complementing these services is title insurance, which ranges from $300 to $500 and provides crucial protection against potential fraud, existing liens, or public record errors. This is normally built into the lawyer's legal fees. And don't forget the home inspection, which identifies structural problems before they become your financial burden. This ranges from $400 to $600. There may be appraisal fees, which ranges from $500 to $600 depending on the lender. The big banks in Canada normally includes this fee within the transaction. After moving in, be sure you estimate the property's operational costs accurately. Expenses such as property taxes, which generally range from 1% to 4% of your home's assessed value annually. These taxes directly funds important local services. Also, home insurance, required by all lenders, costs between $100 to $400 a month depending on your property characteristics and coverage needs. And finally, your monthly utilities typically range from $350 to $500, with seasonal fluctuations that can impact your budget throughout the year. I think this next strategy is most overlooked, but it may make or break your dream of home ownership. Co-buying with family or friends has become increasingly popular, but requires serious documentation. You'll need a comprehensive co-ownership agreement that specifies how the property will be managed. This agreement must detail ownership percentages, expense responsibilities, and exit strategies. For example, siblings purchasing together might specify that if one wants to sell, the other has the first right to buy their share at market value. Legal costs typically range from $2,000 to $3,000, but it protects everyone when disputes arise. When applying for a mortgage, each co-owner must provide identical documentation. Everyone is jointly and severally liable for the entire mortgage amount. If your co-owner stops paying you, you're responsible for the full payment. Also, be sure to research organizations like Arbor, where owners can co-invest up to $250,000 towards down payments, sharing in future equity gains or losses. And don't forget about rent-to-own arrangements. These require specific terms to be enforceable. The option fee, normally about 2 to 10% of the purchase price, secures your right to buy within a set time frame. Monthly rent includes premium of $200 to $500 toward your future purchase. The agreement must clearly state the purchase formula. You'll need credit reports showing improvement potential, income verification, and a document savings plan with consistent deposits. If you still think home ownership is a far-fetched idea, get your mind out of that space. I believe it's possible for anyone with a lot of hard work, but it won't be easy. Let's use a hypothetical example. Jack is in his 20s, just graduated and found a great job. He wants to buy a house, and there are many benefits to home ownership, which is a topic beyond the scope of this video. His partner and him have saved up $20,000 each over the past 2 years. They want to stay within an hour's drive of Toronto because that is where they work. In this example, they will use some of the strategies covered previously in this video to purchase their first home. After some time, they saw this property on the market. It's a great property at the edge of the city, close to the freeway, which makes traveling to work easy. Here's the breakdown. Let's start by calculating how much down payment is required to purchase this. For properties over 5 units, the bank normally needs 30 to 35% down, but this is a fourplex. For properties under 5 units, the borrower may qualify for a minimum down payment as previously discussed in this video. That means they need a down payment of $95,000. In addition to the closing costs such as land transfer tax, legal and appraisal fees, which will be approximately $25,000 in our example. Use an online calculator to calculate the land transfer tax. Keep in mind that in Toronto, we need to pay double the land transfer tax. But Jack and his partner may be eligible for a lower land transfer tax rate as they are first-time home buyers. But let's just assume they don't qualify for simplicity's sake. Therefore, they need a total of $120,000 to close on this property. Now that we know how much capital is required to purchase the property, Jack and his partner will use the co-ownership model to make the initial investment lower for each of them. Since it's a fourplex, it is possible to have each couple live in each unit in this example. Therefore, they need to find 8 couples in total to get onto this deal, where each person contributes $15,000. The math is essentially $120K divided by 8 people. It is recommended that they actually search for 16 people in total and put them on a waiting list, just in case some change their minds at the last minute, which is a real possibility based on my experience. Finally, after asking friends and family first, then third and fourth degree contacts, totaling around 60 people or so, Jack and his partner found 6 other couples. Their plan is to hold the property for 7 years and then sell. Once they sell, they will split the profits into 8 equal parts. They will then part ways with the other couples and take their share of proceeds to purchase their permanent home. You see, saving is too slow. By the time you save enough, you can no longer afford that particular property because the appreciation of that property will outpace the speed in which you are able to save. I would recommend that one acquires the property first, then ride the wave of appreciation complementing your savings. Anyway, back to the story. Jack and his group will borrow $1.1 million. It's basically the purchase price minus the down payment of $95,000. And if they are borrowing at 6% with a 30-year amortization schedule, their mortgage payment will be approximately $6,600 a month, as you can see in the Scotia mortgage calculator. Don't forget to add the operating costs such as utilities and property taxes. At the end, this will be about $1,000 more. So if you divide all of this by 8 people, each person will be paying only about $950. It's essentially $7,600 divided by 8 people. When did you recall rent being so cheap? I don't remember either. And the best part is, each payment goes towards paying down the debt and not the landlord. In real estate, it is fundamentally important to look at the long-term strategy. If you look at the past 7 years, the real estate in Toronto has increased from around $700,000 to $1.2 million. It's not about timing the market, it's all about time in the market. In the graph, real estate has nearly doubled in 7 years. So in our example, you can forecast the future value of Jack's property. If he holds it for 7 years, the property may be worth around $2 million. His remaining mortgage at that time will then be around $990,000 based on the Scotia payment schedule. By the way, I'm not sponsored by Scotiabank in any way. Let's do a rough math to see how much each partner should receive at exit. A sale price of $2 million, subtract the remaining mortgage amount of $990,000 gives you about $1 million in profit. Divide that by 8 people. Therefore, each participant of Jack is expected to receive around $126,000 when they sell, minus the legal fee, which is around $2,000, small compared to the grand scheme of things. Make sure you time your sale with the end of the mortgage term to prevent early mortgage termination fees. Jack didn't just use one technique here. He used the new mortgage down payment structure, the new amortization schedule, along with the location and co-ownership strategy in order to purchase this property. I hope that you can see, breaking it all down like this, home ownership is within your grasp. Keep in mind that to put this deal together takes a lot of work, especially searching for the people that will show interest in this type of arrangement. It is quite unconventional. You may even go as far as putting together a pitch package. But there's this saying that inspires me. 99% of the people who quit too early end up working for the 1% that kept going. So if you really want to do this and you believe in yourself, be sure to watch my next video on the first step. How to save money for a down payment without sacrificing the quality of your life. Hope this helped, and thanks for watching.